Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. Sorry about last week. I forgot to send out the reminder, and I know some people rely on that link. So that was my fault on that one. So today's agenda, we'll go through market update, go through some of the earnings trades, and then Joe's going to rifle through some charts and go through some analysis for you guys. All right, let's get started. So the indices overall are in the same spot. So SPX, NASDAQ in 1 and Russell in 8. So no change there. High wise, we got 47 last week. We got 40. So a bit of a drop, not significant, not to the oversold level, where we're below 30. So we're not there yet, but we did have a little bit of a drop, and yesterday was pretty ugly. So let's look at the market pulse here. You can see, let me zoom in a little more. And we did have that cross on the 25th. That was pretty much like the bottom for the market, the next day. And it kind of popped up. And, yesterday we had a big turnover, but, the bearish have been increasing, but kind of flatlining around here. I think obviously everyone's waiting for the Fed here, to see what direction we're going. I didn't see much else out of that. We got a little bit of a, to put in perspective, a little bit of a spike yesterday, 305. But nothing significant. A little bit also down here, expanding the difference between the belows and above 200s. So we're not oversold yet. So if we get to 30, that would be kind of like a trigger. But right now we're still no definitive real signal from here, and typically we get these large longer like multi-week kind of moves, and like I was saying last week, just didn't feel like that right now. So we'll have to see after the Fed comes out, just kind of chopping till the Fed. So I think all eyes are on them. Let's look at the individual states. Not a huge amount to pull from there either. All right, a little slow today. There we go. Okay. So 1s and 8s. So 8s have obviously gone up, up around 45. Pretty much flat since last week on the state ones, nothing really big there. The 7s, obviously, last week, where were we? Right around 11. So we're down from there. We talked about market breadth. The 5s are pretty much flatline. Like this is really telling us there's no breadth in the market. We got this big run up in the S&P, but that's driven by like a Facebook results, and some of these companies having really good. Microsoft obviously was a huge move, and the rest of the market, what this is telling me, is not participating. When you have the 5s and the 7s pretty much in the gutter. 2s. The 1s, 1 to 2, not too much. I mean, you got 8% left. That can pop up into 8 from here. So that's just telling me, it's going to be a while for those things 1 and 8 to cross. It'd take quite a long time, and we'd have to start seeing the 7s, then the 7s to 5s, and then the 5s to 1s. So we're pretty far off from that right now. Okay, let's go into the analysis here. So we got SPX still in state 1. Had a nice little pop up. That was the current high in the state. Our big kind of line in the sand, our range is at 4,200. So didn't cross that. We got up to 4186, so kind of close to it, but turned around obviously with a big down day yesterday, and I think today's fairly flat. So I didn't see where we are currently. 4130, so we're up a little bit. So, still in one. So, the kind of the key things, that entry price, that 4,100 range. You can see we bounced off that yesterday. We got below it and ended up above at the 4,100. So that's kind of short-term support right in here. We want to, for bullish people, obviously you want to stay above that 4,100. But, the real key, at least upside wise, is that 4,200, and this is our range. So we're up in the top end of this range. So, kind of in between this little, this 100-point range of 4,100 to 4,200. So we'll see if that 41 can hold. Doesn't look like it's going to break that 42 though, the way it's been acting. The last time we got there, we got 41.95 was the closest as back in February. So this was, the closest we've been, about 13 points off. So, getting up there, but obviously, the next day is down big. So that's our ranges. Let's pull up. I think, one bullish sign was right in here. Let me get the tool out. This was a kind of a bullish sign for me here. We'll have to see if it continues, but, bounced, showed good support on that 50. So, if that can continue, provide good support, that could be a good indication that things are looking a little more up overall. So, bullish markets, we'd like to see those as strong support. So let me pull it out more. Just do the kind of range. So or there we go. So we'll do the long-term one here. So that's our 42, and the bottom is at 38 there. So we're obviously up near the top end of that range. 42 is going to be key, to break, if we want to break to the upside. And then, kind of short term, going to be watching, state modeling wise, it was 4,100. On this chart, the 50 is 4065. So that's probably more important than that 4,100. A little bit lower, obviously, but just to kind of get bullish, we'd want to see this providing more support, and then breaking 4,200. So we'll see. Not too confident that's going to happen, but let's see how the Fed, what comes out of the Fed's mouth today. So Russell, obviously just chopping, below the entry price, 743, got below there yesterday. Right now we're right above it. So, I think it was a good sign. We got kind of near that 17 and, pulled back. We got down to 1713, and finished at 1730, and obviously up today above the entry price. So, that's a good sign. Obviously bullish wise, we want that 17 to hold. That's, and the range is 17 to 19. So obviously on the low end of the range, but, entry, excuse me, 1 second. Sorry. All right, so entry price, staying above that. Obviously, it's been kind of chopping back and forth the last week. So staying above entry price and above 1700 is critical. For bullish camp overall. So pull up the chart, kind of the inverse. I mean, you look at these like SPX, it's above the 50, above 200. This one's below the 50, below, the 200. So, just the breadth, this is 2000 stocks versus 500, but, I think this is really being carried by, especially last week, some of those big names propping it up. So overall, sorry, I moved it too much. There we go. I'll put the lines here. 17, and we got this 19. So, I think it was somewhat bullish. We got kind of close to that 17, finished higher today. Critical level, that 1700, obviously. We got a long way to get up to that 19. It's fun, just kind of throw it all together. I mean, but to see a lot of these, 8 start going to 7. I mean, these are pretty low levels. The 5s are really low, 7%. We'd have to see these 8s start moving here, the 7s here, and then kind of up here, along with the 2s, obviously, start moving to 1s, for us to get bullish. So still range bound. We'll have to see, obviously those key defined ranges for the S&P, kind of near the top, the Russell will kind of near the bottom. We'll have to see if either one can break, but you got your targets there for each one. Okay, Fed obviously big today, 87%, so over 80, it's pretty much a lock. So it's going to be a quarter hike, unless they really shock the world. I don't think that'll happen. So, I think it's important to, me and Joe were talking this morning about like why this market's, held up so well with, like some of these banks. I mean, we've had some good earnings, but I think a big thing is, the expectations of the market. So end of the year, we have, we'll be at 5. So, by the end of the year, they're expecting, like 75 basis point cut. So at some point here, late summer, early fall, they're expecting rates to start coming down. So, if you go even further out, like December of 24, I mean, you can see they're pretty much saying, from here all the way out, the rates are going to be slowly coming down. So that's what the market, the market's obviously forward looking. So how does that happen, right? So the good way that this happens is, the inflation numbers start coming down. And the Fed could say, oh, well, like the rates are, our inflation readings are coming down. We can start lowering rates accordingly. The other way is something bad happened in the economy, some more bad things. Obviously, some bad things have happened already. Something big to make them cut, and I would expect that to be a big cut if something like that happens. So market's pricing in, and obviously that wouldn't be bullish. I don't know what it would be. Obviously, the focus right now is on the banks, and we'll go more into that in a minute here. But this is what the market is pricing in right now. So,
Gotta be more bank failures.
What's that?
Gotta be more bank failures. The First Republic.
Mm-hmm.
went under and people
Yeah, I
suspect
guess.
it's either that or they don't come to an agreement on the debt ceiling.
Yeah, I don't think that, I think that's gonna, I mean, that's like political suicide.
I agree.
Uh,
I hope cooler heads prevail, but
Yeah,
they're running out of time.
right. Yeah, I mean, yeah, I still think it's a, you know, liquidity, credit issue. You've been saying that from the start. The other thing that, some kind of war escalation, obviously, could be another, looking in my crystal ball, it's a little cloudy. But, this one's, this one, just so you know, this is the market expectation. So if these are wrong, one way or the other, the market's going to get repriced, right? And we had talked about this a while ago, that people weren't expecting, as fast a hike as, happened, and, that wasn't good for the market. So, if this doesn't pan out, the market's going to get repriced, starting with today, on what they say. Because they're saying that there's going to be no cuts through this year, but the market's already pricing it in. So it's dislocation, someone's going to be right, so and the market will get repriced for that. So we'll have to see what comes out of the Fed. I'll do a little deep dive on the banks here in a second. This is going to pull up the balance sheet. Obviously, they're sticking to their word. Had another 30 billion run off. This is our little banking crisis, but they're continuing, as they've said, to run it off. So got a little ways to get back to where we were. But all right, so I'm going to go to the banking, then I'll open up for comments here. So this is something I saw about First Republic. So you can see, very large balance sheet, 37 billion. I'll bring up my annotation tool. So they had a giant book of low interest mortgages that have been dented since they raised rates. And we talk about this, right? We talk a lot about, the bonds they're holding, but the mortgages are the same. If they want to get rid of some mortgages off their books, and those are 3% mortgages, they're gonna take a haircut, on what they're worth. Same thing with, any kind of treasuries they hold. So it's kind of compounded, with these mortgages, because they were, low interest rate environments. These are all 30 years for the, I mean, well, a lot of them, not the commercials, but, all the home loans and stuff like that. So their book, they had 19 billion just from mortgages, 80 from other loans. So that was 27 billion, right, in unrealized losses. And at one point, it was 13 billion in equity. So, they're underwater. And that didn't even factor in whatever those treasuries they were holding, however much, they lost on those. So that's kind of a snapshot of these banks, right? So I wanted to pull up an article, and I'm gonna put this in the chat so you guys. I told you, like, the Yahoo Finance, so much garbage in there, but occasionally they have good articles. So this is a good one. I put it in the chat. I cut it out and saved it. So, in the post-meeting email, I'll include this attachment. So half a bank's already insolvent. So
Yeah,
yeah.
Josh, this is
Yep.
Dave. I read
Hey,
that
Dave.
article earlier too, and as far as First Republic goes, JP Morgan bought them, did they not? I think they bought them,
Mhm.
And this is what I heard, is that the equity holders got wiped out and the bond holders and the preferred stockholders were all wiped out. And depositors are the only ones that may be saved by the buyout.
Right.
So
That's what I heard too. And, they got some of the assets and, the government's eating some of it. I think it's a pretty sweetheart deal for JP Morgan overall. I mean,
yeah, I think,
they were up a decent amount that day.
yep. But in my opinion, it's going to put the bite on a lot of bond sales for all the regional banks. They're not going to be selling too many bonds too much into the near future here with all the turmoil that's flying around.
Yeah. Yeah, I agree. I mean, this is, also factor in, I mean, the money supply is shrinking, right? So there's less currency out there. So that's some of that's going to come out of deposits. We talked about this last week, money markets. Like, where do people put their money? Where they can get the best yield for the, safest return? We showed you that JP Morgan, savings and checking rate of 0.01. And these are money market fund yields up in the, 4, almost 5% range. So that's where a lot of money's leaving the banks, and, you go park it there. You can buy short-term treasuries. We go through those, how much those are yielding. So that's why a lot of these deposits are, leaving the banks. I mean, it's a smart thing to do. I don't think it's going into real estate. I follow a couple of real estate guys, and like the cap rate, is lower than what you can get in these, like money markets and treasuries. So, the investors would, it's a tough, with all the risk, in real estate, inherent in like a real estate investment, there's no reason that they would be doing that right now, when you can get this pretty safe. I mean, very safe, not treasury safe, but, right next to that. So it's, it's just a matter of thinking about, okay, where's the money going? Like, where's the best yields, and figuring that out. And that's, we talked about that last week, but so the banks are going to continue seeing outflows, right? I think that's the end of the point here, as people wise up, and like, why am I getting 0.01? I can get 4.5 over here, I think Apple just opened a bank and they're paying 4%. It's all like $1 billion in the first like week or something. So people are gonna, find the yield, especially after decades of getting paid trash, like savers have been crushed because there's nowhere to get it, so they had to go in the market, they had to go in real estate, they had to find different places for it, right? To get yield, like retirees and stuff like that, so dividend paying stocks, stuff like that. So now they finally have a place, it's not a savings account. It could be CDs, it could be money markets, it could be treasuries, and those are all very safe, and they're paying a lot more than, the real estate cap rate, and a lot of other places. So, and definitely checking and savings. So, okay. Thanks, Dave. Feel free, you guys chime in. So, half of the banks, 4,800, I guess the total, are running negative equity. Pretty much the same thing we just talked about here. Tangible equity is negative for what this guy said is half the banks. So that's a concern. And, I was looking at a balance sheet, I looked at Wells Fargo, the way they kind of get around, like they don't have to mark to market like, what's the current price of, if they intend to hold it to maturity. So they're not, if they have, 50 billion in long dated treasuries, they don't have to say what the current market value is if, they just say, we're going to hold it to maturity. So, but, so this guy at the Hoover Institute, haven't heard of that before, but they calculate almost half. So, 48, 23, 15 are sitting on assets worth less than their liabilities. And they're looking at 2 trillion. The loan portfolio is 2 trillion lower than the book value of all those companies. So it's not just isolated, right? And here's another kind of, we talked about, mortgages, obviously those banks, usually intend to, sometimes they, sell them off their book, but most of the time they intend to hold them to maturity. If the lenders, the lendee is well capitalized and all that. So this is talking about commercial real estate. So what they're talking about here is 4 to 5 trillion of debt in commercial property sectors, and 1 trillion maturing in the next 12 to 18 months. So these are not your 30-year fixed mortgage. These are a lot. These are floating rate. So, it's depending on, what the current rates are out in the market. Obviously, when, they created these, the rates were a lot better, right? So now the rates are going up and the values of a lot of these properties have dropped. So it's going to be a pretty big nightmare for these commercial properties, as this thing unfolds more and more. And the banks obviously are involved. A lot of the regional banks do these commercial properties, from what I've read, more so than, the bigger ones. So I think that was the big part here.
And the reason for that, by the way, let me chime in there too. The reason I've read for that is the work from home or not having to work at the office, which seems to be not retreating back to everybody going back to the office. So that's like going to be a persistent hangover for the commercial real estate kind of group. So that's and I don't think it was the Apollo guy. I think it was one of the other. But it was like the founder was saying, yeah, it's going to be a problem for a while because a lot of people are still working from home. We don't see that turning around right away. So it's going to really put the pressure on new leases. So.
Oh, definitely. Yeah, just like a lot of you guys have been here on the 4th floor, when you were here like a while ago, pre-COVID, we had, let's see, 1, 2, 3, 4, 5 total companies, right? On the floor was filled. Right now there's 2. And we're one of them. So the other ones are just sitting empty. There was like a real estate one. They had like 40, 50 people. It's been empty for years. So, that's just, my little microcosm, but, it's interesting. And I don't think a lot of these are coming back to the office. Some are. I think there'll be some, especially as, lease rates drop because, they're vacant. They may be like, okay, yeah, we can afford this now, or, it's a good idea. We can do it smaller. But the work from home, like, Joe says, like, COVID changed the world. So, I think a lot of that's not coming back. But, I did kind of like this sum up, and I kind of agree with this. The Fed has no intention of backing off. It's going to raise rates. I don't know if we're going to raise rates after this, but we're definitely raising today. It's going to continue shrinking the money supply, just like it said. And, it's basically you have to pick between two poisons, either, capitulate on inflation or, the banking crisis. So, what the market's priced in is, inflation rolls over and we slowly lower rates and, we get out of this and what I guess people call a soft landing. So that's what the market's pricing in currently. Now, what happens? Anyone guess, but, I think the banking crisis is not over. Just based off of, the stuff we read today alone. These are just first few dominoes to fall. So, and there's a lot more in trouble. So we'll have to see. All right, I think that was it. Yeah, this is another one real quick, lending standards. This is global, so US, Europe. So we're back up. And I didn't see the metrics on how they calculate this, but basically it's saying, we're up kind of near peak of 2000. And, it's hard to get credit. That's pretty much makes sense to me. So, all right. That was it. You guys have the article, and I'll open up to questions, comments on the market overall.
I agree that everybody's waiting on the Fed, but I think they're going to raise and hold.
You think you're going to continue raising after this?
No, I think they'll raise today and then hold.
Yeah.
I don't think they're going to give any indication that they're going to lower rates by the end of the year.
I think, yeah, I mean, they say they're not going to lower rates this year. Yeah, I agree. I don't think they will at this point until, unless something happens, but, they're not pricing in anything for June right now. Do you think they're going to end up cutting by the end of the year, Sudhir?
No, I don't. Powell said it clearly in the last. He was asked the question directly about this chart, this Fed Watch tool, showing, that they're going to cut rates by the end of the year. He was asked that directly in the last press conference. He said no, they're not foresee cutting rates by the end of the year. So I think they raised 25 and they're gonna pause. I don't see them lowering the rates.
Yeah.
I'm not sure they're going to take all the, they're going to say we're done now, though. It'd be interesting to see what the verbiage is that comes out in the press conference afterwards. It's the tone of the tone that I think turn the pricing in the S&P. If they come out hawkish and say, well, we're gonna raise now and we're gonna look at the data again for next month, that would be bad. If they say we're gonna pause for sure after they raise today, if they raise today, if that's indeed true, then I think that's dangerous, because that will signal to a lot of people that it's all clear they're not going to raise again, and that'll be it. So he's got to watch what he says.
Yeah, I'm pretty confident. They're going to be. He's going to say they're going to be data dependent.
Yeah.
So the key will be watching, the inflation readings that come out. To get indications on, where inflation is.
Yeah, we have a non-farm payroll this Friday too.
Yeah, that's should be big.
Yeah,
and that's really about it from a numbers standpoint. And they're looking for the lowest expectation that we've seen in quite a while. It's below 200, so they're looking for 190 on Friday. So yeah, Dave, it'll be interesting to see.
Oh, I didn't know it was that low. Yeah. Another little uptick here, 3.6. 190, 180. Yeah.
Yeah, we haven't had below 2 in quite a while.
Mm-hmm.
Well, the ADP number came out. ADP usually comes out before, and it was much higher than expected.
Hey,
Goodness.
hey, Sudhir, that, I know, what exactly, do you know exactly what that ADP number was? Because, yeah, it was off the charts.
Well, it's that company, ADP, which does payroll.
Yes.
And
Right.
they report the increase, and a lot of small businesses use ADP to do the payroll, because it's a small business owner to
There you
hassle
go.
with yourself, and they do it pretty cheap for you. And it said that their private payroll surged 296,000 in April, much higher than expected. So that's actual payrolls, increases in payrolls that they're doing, right?
Mhm.
So
Yeah, for all the companies that use them.
use their service, yes.
Yeah, yeah. Yeah, they're one of the big two as far as that.
Yeah. So the unemployment number or all that may come in pretty low.
So you think non-farm will be higher? I don't know. We had that crazy non-farm the other couple months
2 months
ago.
ago, 5.25.
Yeah.
Yeah. I don't know if this one, we'd have to like do a little analysis, like how well they correlate.
Yeah, I've never
I
seen
actually,
how well they correlate to the first Friday jobs report. But
Mhm.
they always come out a few days before, and it
Right.
would be interesting to see how well they correlate.
Well, let's see.
actually, I read something within the last 6 months about ADP numbers versus at least the non-farm payroll. I'm not sure if it was jobless claims, but it said the correlation was not strong. But go ahead, Josh.
Really?
Yeah, so there's ADP and then there's non-farm.
Yeah. So maybe it's not a good indicator.
I think what I read today was that it's somewhat erratic.
Ah, okay.
Well, yeah. So that's January. This had 119 and that was that big number. The July had, big number for both of 2022. Yeah, but that's weird, right? You had 119 there and like this huge number. Anyway, always interesting.
I like the correlation between the oil inventories from the API and the EIA.
Yeah, what's going on with oil? I mean, that thing's like tanks past couple of days. Is anyone, I haven't heard anything. I mean, recession talk or, I mean, it's dropped like, where are we at? Like 70, like almost, $10. I haven't heard anything. There's April 12th, we're at 83. Now we're at 68. It's like a cliff right here. I haven't heard anything. I don't know if anyone else has. This is kind of
Well,
strange.
what I've heard is that they're now, you hear this from, you got to recognize the source, right? So the sources that you always hear from or typically hear from are from the oil industry themselves.
Mhm.
And after OPEC said they were cutting production, when I think they went up $10, like overnight. And now they're saying, well, now there's this recessionary fear. So now it's potential demand that is dropping the price of crude oil,
Right.
Well, who thought it was really going to go up so much? And, that's what I say, but that's the reason that I've been hearing is for the price of crude to come down. Now, the oil stocks themselves are still doing pretty well. So.
Yeah, I mean, that's a pretty sudden move. Yeah, I don't know. Okay, thanks, Dave. All right, real quick, virtual portfolio for earnings has not been stellar. I'm not gonna lie. Bullish pre-runner. So we're down over almost 900. So we got this one's been killer. ALB.
Most of it has been this Albemarle.
Mm-hmm.
It, you know,
That
and
was
I don't know how you predict that Chile's going to nationalize lithium. You know, it's kind of a, you know, unique circumstance, but most of the loss is this ALB, which today's the closeout for that one, and it's
Yeah.
gonna.
Yeah, that's gonna be a bad one. Yeah, the other ones, yeah, this, obviously the oil hasn't been good here either. It's kind of bad circumstances. Other than that, you know, we had some like narrow winds, flat. Yeah, then we had quite a few winners. So only one, you know, that Avis did at least came back some. It was down more. So definitely not a good pre-runner, bullish pre-runner quarter. You know, the bearish, we only had that one pre-runner that was a winner. Bullish runners real quick. You know, quite a few open here, down a little bit, you know, 5 closed. You know, banking type. So, you know, if we can get a little bounce on these, I think it'll be all right. This Lily probably will close out a winner, you know, but 9 open, you know, down like 400 something. You know, 5 closed out. Those were all profit target hits. So this book's still out. Obviously, you know, maybe it can pull its weight, make up for the bullish pre-runners. Bearish runners. Yeah, we got one open overstock. That's up, and then T-Doc closed out. That's the bearish. So the bearish trades are doing well. The ball rise are not doing well either. This Chegg or whatever got, I don't know if you guys saw that news. It like got destroyed after earnings. So that would have been a good hold.
Yeah, if it held past earnings, that probably would have been profitable.
Mm-hmm. Definitely. I mean, you had the 15, it's at 9.
Yeah,
Yeah. Probably
Yeah.
would have been.
yeah, that's not the rule on the ball rise.
No, don't change rules. So and we have one open, you know, down a couple hundred. Hopefully Disney will make it up. This is a short-term one, I think like 6 days. And then we got our non-movers. So these ones have been doing well. We got 4 open. Those all opened on the same day on the first. We had the one that closed out the fast. That was a good profit. So hopefully these can all close out and lift the boat for, you know, the other, for the bullish pre-runners too. So I'm pretty confident these, you know, you got 2 weeks for these to come, you know, get over 20%. So I think pretty confident this will, you know, yeah, I don't think it's going to be like a banner quarter, obviously, with the bullish pre-runners not performing, but I still think we can be profitable overall. So I think this is going to be key in the bullish runners too. So that's it. Is that any questions on earnings before Joe gets going? All right. Joe, you ready?
Sure, Josh, thanks. We'll make this, you know, kind of quick so everybody can get to the Fed announcement. Let's see, just the few charts I wanted to hit up. Let's you know, basically with the ETFs, we all of them were in bullish stage yesterday, and then you know, 2 days ago, and then last night a few of them flipped back to bearish. So we have total of 9 bullish states. I was going to pull up each of the state 1 XLFs just to take a peek. So, we've got technology, which has kind of led the charge. As we know we've been talking about that for quite some time. And get and then a lot of these that are in state one are just kind of sideways. But I just thought maybe useful to take a peek at them as we go into the Fed announcement today, the state ones. Last week, I guess we were 7 state ones. This week we're 6. The talk of oil getting crushed rolled that XLE from state 1. I think it's in a state 4 at this point. But they're the materials, communications, it's been one of the leaders, but as Josh pointed out yesterday, was a tough day for a lot of the markets. We got the industrial sector. I mean, talk about a trading range. There you are. Not much happening there for sure. We've got the consumer staples, which we talked about, a month or 2 ago. Certainly, there's been leadership there as well, and healthcare, which that rolled into state 1 last week, and just kind of hanging out. I think I have. Okay, so then the other analysis I just want to do kind of quickly were the bonds that we follow. So just going from the 20-year to the, I think it's 7 to 10 year to the 1 to 3 year. And, silly me, as I pointed out to Josh, I really hadn't realized, to me, this isn't so much about, the last month and a half on this chart, which obviously is just sideways, but I had not realized, and it's true of all 3. So here's TLT with the 20. We've then got the IEF, which is basically the 7 to 10 year. And then you've got the, I guess it's the SHY, the short-term 1 to 3 year. Obviously, the rate term structure, impacts us a little bit. But when I looked at this thing, this morning, I was like, damn, how did I not realize, that, basically the rates had topped out just after the market bottom. So, we had the Delphian state bottom, in the June period of last year, very, very extreme. We've got a good rally off of that. And as we know, the market, rallied into August and then sold off hard into October, September, October. And then, we got a bit of a retest in December. But, here rates were, and, the market bottomed. It was basically in here. And, the market probably led the interest rate market by 2 to 3 weeks. Rates topped out at basically late March, and we've been, working our way a little bit lower since. But there's TLT, and I just thought, besides that bottoming process, which again, for whatever reason hadn't dawned on me, and the fact that we've got the Fed announcement today, I thought it would be useful just to take a peek at these. So there's the 20-year, here's the 7 to 10, completely sideways for quite some time, and then there's the shorter term rate as well. So there are rates. Be interesting, I guess especially be interesting to see where the market closes by end of day Friday, where we've got those non-farm payrolls on Friday. We got jobless claims tomorrow, and obviously we get the Fed announcement as well. Let's see, a couple other charts. Sudhir, I thought it might be useful. We finally got the IYT in here. Definitely can be a pretty good indicator for the strength or lack thereof of the economy. But like so many of our darn charts, it's sideways. It obviously gave us a state 8 not too long ago, which for the time being looks like it was not a good signal. But
that's an important ETF. Thanks for doing that.
Sure. Well, I assure you, Josh and I had asked a couple times, and it took a little far longer than we had hoped. But there you are. And we'll see whether that state 8 just turns out to be one of those 8s at the bottom, which occasionally we get. So there's that. 2 other charts, and I just pulled this up because we were talking about Lilly last week before the earnings. I think their earnings were less than expected. I don't know what the story is. But obviously that thing, has just continued to take off. We got some bad data here that our tech guy is out this week. We got to get that cleaned up. But, there's one that's taken off. And then, we've been talking a lot about JP Morgan, so I thought it'd be worthwhile just to take a peek at that. This goes back to the COVID low. So you can see we're still off all-time highs in JP Morgan, but, doing pretty darn well. Let me just shrink this a little bit. Yeah, it's a little closer look. We're in state one currently, and Morgan, here we are. That market bottom, was. I think some of the financials were. No, that's right. It was the 12th and 13th in October where we got the lows, and then it was a couple weeks later that we got the high-end rates. So I think that's all I wanted to talk about today. I know we got Fed, and happy to take any questions if anybody has them, or also back to Josh.
What's the latest on the new interface?
First thing that's going to happen is a new website. It will not, connect to the new interface, but we're hoping to have a new website by the end of this month. Correct, Josh?
Yeah, I can give a quick preview.
Okay. Yeah, that's a good idea. And then, in terms of the interface, Sudhir, it has to do with, the back end and improving that back end and going to the cloud. And, the process is just taking longer than we hoped. So that is supposed to begin to happen starting next week. Getting to the cloud, that is, some transformation to the cloud. Until that happens, there won't be a new UI. But so it's hard to say. Best guess is within 2 to 3 months for the new UI. Best guess. But here's the website. Go ahead, Josh.
Nice.
So I got a question for Joe real quick. Powell comes on at 2:30, by the way, so a little bit. We talked I think last month you talked about earnings, and you had a report from FactSet. I was looking for FactSet. I wondered if you had a where you could tell us where you go to find like how they track earnings, because I know they do it. In the article that I read just was on the 28th, so it was like last Thursday or Friday. And they said that so far the average S&P earnings were down this quarter by like 3.7% or something like that. But it's early yet, it's in the middle of the season, so who knows what it'll end up. But they did say last quarter was down. So they said if this quarter ends up being down too, that'll be 2 consecutive quarters in a row where the S&P 500 average earnings was down. So that's what was my takeaway from this article. But I kind of like to keep track of that, but I don't know where to go look.
Yeah.
Can you send that to me sometime? We don't have to debate it on the air, but I'd be curious.
Yes, we'll do that. And Refinitiv has a good one too. I think we have maybe posted that, not FactSet, maybe Refinitiv in the collaboration tool in the past. But I'll check that out and get it out to you for sure.
Okay, thank you.
Yep.
Yeah.
One more thing, as we get a little further along in the earnings, we'll definitely talk about what we see as well. So go ahead, Josh.
Yeah. So we'll just cut it down a lot more appealing to the eye as far as homepage. Broke it down by kind of things that we thought were important: earnings, trade ideas, education, and the platform, the new UI. Will be laid out similar kind of graphics, stuff like that. I think I've shown you guys that before, but this should be, we're real close on this. So hopefully in the next few weeks, this will be out there instead of this one. This is the current one. So a lot better.
Good.
Yeah, thank you. Okay. Anyone else got questions, comments before we close it up? All right. Well, thank you all. We'll do it again next week.
Bye, everybody. Have a good week.
Thank you, guys.